Hey, welcome you back to Caroline's Online Academy. In this series of videos, we're actually learning how to solve the 6 mark cash flow statement questions that are asked in the board examinations, CBSE board examinations. In the build up to the videos, this actually is a build up to the video in which we solve the 6 mark question. This is actually the last video that we'll be doing. And in this video, I'm going to be teaching you the format for cash flow statement. I'm going to include all the items now. In every question, you won't have all the items that I'm giving in the format, but I'm giving you the overall format so that whenever something comes up, you will know what to do. All right. So starting with, we always write the name of the business in the beginning. So in the books of XYZ Limited, the cash flow statement for the year ended 31st March 31st, you write whatever year the cash flow statement belongs to. And then you have particulars and one inner column amount and outer column amount. The starting point of the cash flow statement when prepared using indirect method is net profit before tax and extraordinary items, right? So net profit before tax and extraordinary items. So when we start with we start with net profit before tax and extraordinary items, and we calculate the cash flow from operating activities. So I think I will give the heading as cash flow from operating activities. Under that, the first thing will be from operating activities. Under that, the first thing will be net profit before tax and extraordinary items. The first adjustment that we got to do to net profit before tax and extraordinary items in the series of adjustments that we have to do in order to arrive at the cash flow from operating activities is adjustment for non-cash and non-operating items and non-operating items. My dear children, we are trying to find out the cash flow from operating activities, right? So obviously the non-operating items like finance costs or profit from sale of fixed assets or profit from sale of investments or interest received, all those are non-operating items. They are not operating activity items. Those should be removed because we are trying to find the cash flow from operating activities. Similarly, is trying to find the cash flow from operating activities. So if there are any non-cash expenditure, that has to be removed. Understood or not, my dear children? So the first adjustment is adjustment for non-cash and non-operating items. We first write the net profit before tax and extraordinary items in the outer column, and then we start with the adjustment. When you say non-cash, the first thing that you got to remember is the first and most famous non-cash expenditure is depreciation. Now, depreciation is an expenditure. It got deducted in the P&L account. And we're working backwards. We're removing the effect of all the non-cash and non-operating items. So you add it back. Understood or not, my dear children? After you write depreciation, the equivalent of depreciation should come to your mind. The depreciation is on tangible assets. So the equivalent of depreciation for intangible asset is amortization. So you've written depreciation and amortization. The other non-operating item related to fixed assets should be recorded next. And that will be loss on sale of fixed assets. If there had been any loss on sale of fixed assets, that will be added back. And if there had been any profit on sale of fixed assets, that has to be reduced. Profit on sale of fixed assets. The first four items of the adjustment for non-cash and non-operating activity items are related to fixed assets. So the moment you say non-cash, the first thing that should come to your mind is a most famous non-cash item, which is depreciation. You add depreciation. And then the related depreciation for intangible asset is amortization. You add amortization. Then something related to fixed asset is loss and profit on sale of fixed assets. Loss you add back, profit you subtract. And then you have non-operating items, interest paid. Interest paid has to be added. The reason you are adding interest paid is a financing activity. Interest paying of interest is on loans that you've taken. Taking loans is a financing activity, and therefore interest paid will be added back. And you also reduce interest received. Interest received is on investing activities. When you make investments, you receive interest, and therefore it's an investing activity, and therefore it has to be reduced. They are non-operating items, and therefore you're reducing them. Understood or not, my dear children? You also reduce any dividend received in your organization, and then you add back provision for doubtful debts that you have made. Provision for doubtful debts charged to P&L account. Charge to P&L. This has not been tested in CBSE till now. Although they've asked it as a 1 mark theory question, they've asked name on operating item that will be added, non-operating non-cash item. Sorry, the name on non-cash item that is added back, and provision for doubtful debts is one non-cash item that is added back, but it is not been tested in a 6 mark question as such. So that you have to add back, and with that we have almost covered everything that has to be added, my dear children. Understood or not? Everything in the sense, everything from the point of view of CBSE, we have covered. You write these numbers in the inner column. All the less numbers you write as negative numbers, so you don't forget to subtract them within brackets. So you don't forget to subtract them. You don't want to forget that. And the net amount of this total is written in the outer column. The net amount of this total, when added to the amount in the already existing in the outer column, which is net profit before tax and extraordinary items, will give you something, and that is called, as my dear children, operating profit before working capital changes. So basically, we had net profit before tax and extraordinary items. To that, we adjusted the non-cash and non-operating items, and we have arrived at the operating profit before working capital changes. Then you make the next adjustment, which is the adjustment for working capital changes. What is working capital changes, my dear children? What is working capital? Working capital is current asset minus current liabilities. So we are basically going to be making adjustments for current assets and current liabilities. Now, when there is an increase in current assets, it actually results in a decrease in cash flow. I'll give you an example, my dear children. I have 100 rupees today, and I have 20 rupees of inventory. I buy 20 rupees of inventory. So how much money will be left with me now? 80. Am I right or not, my dear children? Instead of buying 20, if I increased that 20 by 50, and I have spent another 30 rupees to buy inventory. Am I right or not, my dear children? So I spend more money on my current asset, which means cash has gone outside. Understood or not, my dear children? So increase in current asset is a reduction in cash flow. So I reduce all increase in cash current assets. So if I reduce increase in current assets, what happens to decrease in current assets? Decrease in current assets is indirectly cash inflow, and therefore I'm going to add it back. And decrease in current liability, I will reduce. Same logic. And I'll add increase in current liabilities. Same logic. Understood or not, my dear children? So now I've made the adjustments for working capital changes. And net of this, I'll write in the outer column. And what I'll arrive at is, my dear children, cash flow from operating activities before tax and extraordinary items. So I started with net profit before tax and extraordinary items, and then I adjusted for non-cash and non-operating items to arrive at operating profit before working capital changes. To that, I made adjustment for working capital changes and arrived at cash flow from operating activities before tax and extraordinary items. From this, I'll reduce tax paid. Remember, my dear children, I got to reduce tax paid here and not provision for tax created. So I reduce tax paid. Sorry. I reduce tax paid and add. Before tax, I'm okay. Yeah, we'll do that. We'll do it together. I'm going to add any tax refund. If you remember, while calculating the net profit before tax and extraordinary items, I had added back provision for tax charge and reduce tax refund. Here, I'll reduce tax paid and add tax refund. I'll also reduce extraordinary expenses and add extraordinary income, extraordinary expenses and extraordinary income. Understood or not, my dear children? So after making the adjustment for extraordinary expenses, extraordinary items and tax items, I will arrive at cash flow from operating activities. And this I'll call as A, my dear children. Understood or not, my dear children? This I'll call as A. The next thing that I'm going to do is cash flow from investing activities. Cash flow from investing activities. Then the moment we say investment or investing, we remember what? Fixed assets. Am I right or not, my dear children? You would have either purchased fixed assets or sold fixed assets. So any sales of fixed assets would have resulted in inflow of cash. Cash would have come in. Am I right? So sale of fixed assets. Whatever sale value of fixed asset is, that I'm going to record here. And then I will, when you purchase fixed assets, cash goes outside. Am I right? So any purchase of fixed assets will be subtracted. All right. Apart from sale of fixed assets and purchase of fixed assets, I might have sold some investment. Sale of investments. And I'll reduce purchase of investments. Apart from this, I might have given some loans to other companies or to some other entities. Understood or not, my dear children? So loans given from the organization is an investment for the organization. We will receive interest on that. Am I right or not, my dear children? So if I gave loan to someone, that means cash is going out of my business. Am I right? So loans and advances made will be reduced. And if I had received the loans and advances back, I had made some loans and advances earlier. Now I take the money back to me, then money is coming back to me. Loans and advances received back. That will be an inflow, so I'll add it. Understood or not, my dear children? Apart from that, on the investments that I've made, I might receive dividends if I've invested in shares, or I might receive interest if I've invested in debentures or any other loans. If I made, I'll receive interest, and all of that are income for me, inflow of cash. So I'm going to write interest received slash dividend received. That will also be added, my dear children. With that, I've covered most of the investing items that are tested in board examination. And that will give us the net of all of this will give us what, my dear children? It will give us the cash flow from investing activities. Cash flow from investing activities. Understood or not, my dear children? The next thing to do would be to prepare the cash flow from financing activities. Financing activities. I'm going to call cash flow from investing activities as B. And the next thing to do would be cash flow from financing activities. When I say financing activities, the first thing that should come to my mind is the primary source of finance for the organization, which basically is shares. So issue of shares. When I issue shares, I get money into the business, and therefore it's a positive number. And therefore, I'm going to add it less. If I redeem shares, redeem means paying back or buying back shares. Redemption slash buyback of shares. That's money going out of the business, and that will be subtracted, my dear children. All right. Apart from that, the next source of finance for me would be debentures. So debentures issued by the company will result in cash inflow, and debentures redeemed by the company will result in cash outflow. Obvious, same things, right? And likewise, I might have taken loans from the bank. Am I right or not, my dear children? So loans received will result in cash inflow, and loans paid back, loans settled slash paid back will result in cash outflow. So I'm going to reduce that. All right. Now, if I had loans or if I had shares, I'll be paying dividends. I'll be paying interest. Am I right or not, my dear children? So less interest paid, less dividend paid. And we also have a tax called dividend distribution tax, which is also paid along with dividend by the company to the government, which is not tested anymore, but I just would like to give it just in case. Dividend distribution tax paid. Understood or not, my dear children? The interest paid is a reduction, this is a reduction, this is a reduction. I think I've covered most of the items that will come in financing activities, and the net of all of this will give you the cash flow from financing activities. Cash flow from financing activities. I'm going to call this as C. After doing all of this, we then would calculate the net cash flow from operating, investing, and financing activities, which would nothing but be A plus B plus C. This A, cash flow from operating activities total, cash flow from investing activities total, plus C, cash flow from financing activities. To this, we add the opening cash and cash equivalents. Now, opening cash and cash equivalents include what all? Cash in hand, cash at bank, current investments are also considered as cash and cash equivalents for the purpose of CBSE, my dear children. Understood? The definition of cash and cash equivalents I'll give you when we are learning the theory topics. But for now, you understand that the current investments in the balance sheet are supposed to be assumed as cash and cash equivalents as per the syllabus given by CBSE. Understood or not, my dear children? So current investments, you add that, and this should result in you getting that if you add net cash flow from operating, investing, and financing activities to opening cash and cash equivalents, you should be able to get closing cash and cash equivalents. And if you get that correctly as per the balance sheet, then you've done your cash flow statement correctly. And if you don't get it, then you got it wrong. You've done it wrong. Understood or not, my dear children? So basically, if you assume that this is equal to D and this amount here is equal to E, then this closing cash equivalence, which is F, should be equal to D plus P. Understood or not, my dear children? If you get it right, then you got it right. If you don't get if your F is not equal to your D and E, then you got it wrong. Understood or not, my dear children? So let me do a quick recap of what we have just done here. We had to prepare the cash flow statement. Cash flow statement has cash inflow and outflow divided into operating, investing, and financing activities, classified into operating, investing, and financing activities. So we start with the cash flow from operating activities. The starting point of the cash flow from operating activities is the net profit before tax and extraordinary items, which you found out through the previous working note. And to cash flow from to the net profit before tax and extraordinary items, you do this adjustment for non-cash and non-operating items to arrive at the operating profit before working capital changes, to which you do the adjustment for working capital changes, which is current assets and current liabilities. You arrive at cash flow from operating activities before tax and extraordinary items, and you adjust for extraordinary items and tax items to arrive at the cash flow from operating activities. Then you start doing the cash flow from investing activities and arrive at the cash flow from investing activities separately. And then you start doing the cash flow from financing activities and arrive at the cash flow from financing activities separately, and you add all cash flow from investing activity, financing activity, and operating activity to arrive at cash flow from net cash flow from operating, investing, and financing activities, to which you add the opening cash and cash equivalents. And that, my dear children, should result in you getting the closing cash and cash equivalents. And if you're closing cash and cash equivalents are right, then you've done it correctly. Understood or not, my dear children? I've just given you the basic format, including all the items. All the items will not be tested in a 6-mark question because they have to allocate marks to each item that is being tested. Am I right or not, my dear children? So you'll only have certain items. There are certain things that I'm not elaborately told. For instance, I told that you have to add back the interest paid here in operating items and adjustment for non-cash and non-operating items. And you have to deduct interest paid here in cash flow from financing activities. That and this are the same items. In operating activities, it will be added back and it will be deducted in financing activities. But how to calculate, I have not taught you. I'll teach you how to calculate interest paid when we are doing a 6-mark problem. Understood or not, my dear children? With interest paid. And here in working capital changes, usually cash credit, bank overdraft, and all are also part of liabilities. Am I right or not, my dear children? But they will not be adjusted along with adjustment for working capital changes in operating activities because those are not working capital current liabilities; they are financing activity current liabilities. So increase or decrease in cash credit, bank overdraft, or short-term loans will not form part of the adjustment for working capital changes here in operating activities. They will form part of the cash flow from financing activities here as loans received, loans settled or paid back. In fact, if you want, we can just add those two items here. So you add in this, we'll write. Just to be comprehensive, bank overdraft increase, bank overdraft decrease. If your bank overdraft has decreased, it means what, my dear children? You have paid it back. Cash credit increase. Cash credit decrease or short-term loans. I think loans cover long-term and short-term. I'm not writing them separately. Cash credit decrease. So they will form part of financing activities, my dear children. Understood or not? They will not form part of operating activities. But that you will understand when you solve the questions. You're going to be solving a lot of questions. All of them are going to be previous year questions. So you don't have to worry about it. We'll go through all the adjustments through those. And in one of the sample question paper questions asked recently, apart from testing how much the usual working notes like provision for tax, fixed assets, they also had there was also a situation where we had to do a working note for investments. You don't have to be scared. Non-current investment working note is the same as fixed asset working note without depreciation. So that is also easy, and I'll be solving that question also, and I'll underline that fact that this adjustment is new when I'm solving that question. Understood or not, my dear children? So with this, we have come to the end of this video. I hope I've explained the format of the cash flow statement properly. As I told you, you don't have to be scared or intimidated. In a 6-mark question, they will not ask all the adjustments. But when you know all the adjustments, when you can remember all the adjustments, it's very, very easy to solve the question. Some people do solve the question after, they just look at the question and try to find out which adjustment is what. What I do is, I just try to remember all the items that can possibly be part of a 6-mark cash flow statement question like this. And then when I look for each of these items while solving the question. Understood or not, my dear children? So when you ask me like, what is the easiest way to solve a cash flow statement 6-mark board examination question? You need to know all the items that are there, and you have to have this checklist inside your head. And as you're reading the question, like for instance, if I start solving the question and if you got the net profit before tax and extraordinary items, the next thing that I have to do is adjust for non-cash and non-operating items. So I'll write that heading, adjust for non-cash and non-operating items. And immediately the first thing related to non-cash items is depreciation. So I'll start looking for depreciation on the question and I'll record it. Then I'll start looking for amortization. So depreciation, amortization related to fixed asset. What else is related to fixed asset? Profit or loss and sale of fixed asset. So I'll start looking for profit or loss, then record that. Then I look for interest received, interest paid. Then I'll look for interest received. Likewise, when I have what will come in the exam for sure, the entire set of adjustments that will come in the exam for sure, I can keep that as a checklist in my head and I'll take them one by one as I solve the question. As I told you, they will not ask all the adjustments, so it will be a lot easier and a lot smaller than what you're looking at now. The format that you will end up preparing in the examination will be a lot smaller than what you're looking at now. But you have to have an understanding and you have to have this in your memory. You don't have to start mugging it up. It's very simple. First 3 items are fixed asset related, then it is finance cost and investment. So if you can relate it that way, and it'll be easy for you to remember. So with that, we've come to the end of this video, my dear children. I wish you luck, and I'll meet you in another video solving questions from the cash flow statements previous year examinations. You people take care, have fun, bye, comment, subscribe, and share the video with your friends. Thank you for your support.